Investing rule: buy low and sell high. The number one rule to investing is buying a company at a cheap price and sell high. As you know, investing can be daunting and involves a thorough analysis. To help you with your investing journey, here's a simplified guide to evaluate the intrinsic value and fundamentals of a company to guarantee that the company you are buying is cheap, so you can sell it at a higher price in the future. Financial statements. Review the company's financial statements, such as the company's income statement, balance sheet, and cash flow statement. Look for trends, revenue growth, and profitability. Ratios. Calculate and analyze key financial ratios like price to earnings, PE ratio, price to book, PB ratio, debt to equity, and return on equity, ROE. Price to earnings, price to book, debt to equity, and return on equity, ROE, are key financial ratios that provide valuable insights into the financial health, profitability, and valuation of a company. Analyzing these ratios can help investors make informed decisions when considering an investment. The PE ratio indicates how much investors are willing to pay for each dollar of earnings. A higher PE ratio may suggest higher growth expectations, while a lower PE ratio may indicate undervaluation or lower growth expectations. Price-to-book ratio measures the market's valuation of a company relative to its book value. A ratio below 1 may indicate potential undervaluation, while a ratio above 1 could suggest overvaluation. It is particularly useful for valuing companies with significant tangible assets. Debt-to-equity ratio assesses the level of financial leverage a company uses. A higher ratio may indicate higher financial risk, as it suggests a larger proportion of financing comes from debt. Lower ratios may suggest a healthier financial structure. Return on equity, ROE, measures a company's ability to generate profit from shareholders' equity. A higher ROE generally indicates efficient use of equity capital, while a lower ROE may suggest inefficiency. RO is a key metric for assessing a company's profitability and management effectiveness. By considering these ratios together, investors can gain a more comprehensive understanding of a company's financial health, growth potential, and valuation. It's important to note that these ratios should be analyzed in the context of the industry, market conditions, and the company's specific circumstances. Dividends. Check the company's dividend history and dividend yield. A consistent dividend payment can indicate financial stability. Competitive analysis. Compare the company's performance to its industry peers. Look at market share, growth rates, and competitive advantages. Management. Assess the management team's experience and track record. Look for signs of transparency and shareholder-friendly practices. Economic moats. Identify any economic moats or competitive advantages the company has, such as brand strength, cost advantages, or network effects. Future growth prospects. Evaluate the company's plans for future growth, expansion, or innovation. Consider industry trends and market conditions. Discounted cash flow, DCF analysis. Estimate the intrinsic value by using a DCF analysis, which involves forecasting future cash flows and discounting them back to present value. DCF, or discounted cash flow analysis, is a financial valuation method used to estimate the value of an investment based on its expected future cash flows. The core idea is that the value of money today is worth more than the same amount in the future, and DCF takes this into account by discounting future cash flows to their present value. Warren Buffett, the Oracle of Omaha and a legendary investor, is known for his value investing approach, which often involves assessing the intrinsic value of a company. While Buffett doesn't strictly adhere to a formulaic DCF approach, he does consider the present value of future cash flows in his investment decisions. Buffett often emphasizes the importance of understanding the business fundamentals, competitive advantage, and the quality of management. Rather than relying solely on mathematical models, he incorporates qualitative factors and a margin of safety into his investment decisions. Buffett has mentioned in his letters to shareholders that he considers the concept of discounted cash flow, but tends to simplify the process and focus on businesses with predictable and durable cash flows. His approach is more qualitative and grounded in the idea of investing in businesses that he understands well and that have a sustainable competitive advantage. In essence, while Buffett may use principles similar to DCF in his decision-making, his approach is more comprehensive and includes a deep understanding of the business and its intrinsic value beyond just the mathematical calculations. News and events. Stay updated on relevant news, events, or industry changes that could impact the company's performance. Investing involves risks, so educate yourself about the financial market, diversify your portfolio, and seek advice from financial professionals. Always remember, by following the guide, you'll be able to buy any company at a cheap price and make more money by selling at a high price. Thanks for watching. Subscribe for more.